My name is Zach Friedman. I'm a business development executive here in Ontario. I am reporting live from the IDC Win Markham office. It is a balmy -10 right now, so happy to be inside, joining and hosting you all for this webinar. We are lucky enough today to be joined by Petra Ross. She is a regional sales director for Desjardins in British Columbia. She also has her associate, Leah Van Stavern, a sales consultant also in British Columbia. They are going to be diving into generational legacy planning, nurturing dreams, and building wealth. So this comprehensive session is going to cover the essential topics, including the importance of wealth transfer planning, effective strategies, and the benefits of the concept and some real life case studies. So we are happy to get started. Petra, we'll pass it over to you and get started.
Thank you, Zach. And yeah, pleased to be here with sharing one of our best, newest sales concepts. So one of the things that we do very well here at Desjardins is our sales concepts. So we have a number of different sales concepts, and we're continuously working to grow these sales concepts so that you as advisors can really present things in a way that I like to use that keep it simple, stupid methodology. So you're showing something to a client that is in their words, especially when we're dealing with, potentially complex things, but we've kept it really, really simple and explained things so well for clients. And so then they can understand the benefits. Okay. So this is a disclaimer. Of course, have consult your legal and tax advisors. This is for informational purposes only. I will be sharing a copy of the presentation after for you, as well as the marketing materials as well. Okay, so today we're going to go through the importance of wealth transfer planning. What are some of the strategies to transfer wealth? And then the generational legacy plan concept, so our newest sales concept, and then a couple of case studies. And then there'll be time at the end. So I will go on to Webby and then do an illustration and show you the exact sales concept and how to run it as well. Okay, so this is a plug for one of our other sales concept, which is the estate legacy planning, and essentially what this does, the wealth erosion. So this shows essentially how your estate is eroded due to probate fees and taxes. So with the estate planning concept, then what you're doing is you're entering the client's assets into a spreadsheet, including their registered and non-registered assets, so either taxable investments or real estate. You're entering in their total assets, even their current contributions, if they're still young and contributing to RRSPs or taxable investments for retirement, rental income. It's a full spreadsheet. And then what happens is you essentially enter what their proposed date of death would be, and it comes out with a full report, which includes this lovely picture, which will show the exact dollar amount of how the estate is eroded. So it's going to show exactly what the probate fees and what the taxes are, which of course is the largest portion, is the CRA is taking. So one of the things I find that we do very well within these sales concepts is we explain things with a picture. So if you've ever met with me individually as an advisor, you know I love my snippet tool and I love explaining things. Whoops. I love explaining things with a picture. And so I'll use the snippet and the highlight and the pen. I've even taught advisors how to use the snippet tool because it's so effective to explain things with a picture. So that's something else that we do very well, is not only explain things simply with words, with that keep it simple, stupid, um, you know, methodology, is that we explain things very, very well in a picture, which we're also going to show for this concept. The generational legacy plan, this is the estate planning. So be sure to connect with your local wholesaler about this concept as well. And I believe that one was probably presented last year. I can always present it again at another time. Okay, so wealth erosion is an unfortunate reality when we have taxable investments, or even when we're rental real estate that you're passing from first generation to second generation to third generation. what do we see in these pictures is the red. Okay, so the first generation to the second generation, it's considered a deemed disposition. And we see that really big red block there of CRA. So we know that there are taxes payable going from first generation to second generation when you have traditional taxable investments. Again, when you're going from the second generation, now we see two red blocks. Actually, the CRA is taking it twice. It's a deemed disposition. Again, you're having that wealth erosion. And you have gains are realized, taxes due before transfer, again to children, and then again to grandchildren. So how can we preserve that wealth for our clients? So what we really want to be doing is wealth preservation. So as advisors, you really need to be positioning yourselves as, get that elevator pitch. Like, what's your 10-second pitch as to what you do for clients? It's, I help clients preserve wealth, or I help clients minimize taxes. However that might be, just make sure that you're using that wealth preservation type wording. So, because here we have, when we're using participating life insurance, you can see that we're going from first generation, second generation to third generation. Using a life insurance policy, it's considered to be a tax deferred rollover. So, where it's not a deemed disposition, it's tax deferred rollover when we go from, again, the first generation to second generation, and then, of course, down to third generation. When we use participating life insurance, we have cash surrender values available. And I had a really good discussion yesterday about, for those of you that aren't aware, do you know that Jim Pattison and Walt Disney, Jim Pattison, of course, I'm in BC, very, very important figure here. He borrowed initially off his cash surrender value to start a business. So it's really, really important. Those cash surrender values are yours, that you have access to as a participating account holder. When you go to the bank, you may or may not be eligible. So when we have a transfer without taxable disposition or payable as a non-taxable death benefit, so we see that you have the death benefit, of course, going directly to the beneficiary as well, and non-taxable. Okay, what are some cost saving advantages for grandparents to use participating life insurance? So again, we're going to be preserving those assets. So we ensure grandchildren receive the maximum benefit from their gift. So we'll go through an example for that. Minimize costs. We know estate planning strategies may reduce estate costs and taxes. So what estate administration? We have avoid probate fees and delays in distribution of assets to their chosen heirs. So grandchildren or grandparents always want to do amazing things for their grandchildren. They may have significant assets and they think, oh, well, I'm just going to gift money, or I'm going to buy excessive gifts. So using life insurance as a way, is an alternative that we can do that, but actually much more tax efficiently than just providing gifts or taxable investments for those grandchildren. What are some of the non-tangible benefits for grandparents? And some of these actually really get forgotten. So the biggest one is the smooth transition of wealth. So as you know, when you have some of your grandparents that have multiple assets, some registered investments, taxable investments, real estate, it's trying to figure out who should go to what can be very, very complex, and keeping things equitable can also be very, very complex. Using life insurance can make things much simpler and straightforward and equal when we have multiple grandchildren and we have different adult children that have different spendthrift or their own potential issues. Some may or may not have children. It can be very tricky, as you know, especially with blended families. So when you have grandparents that want to transfer wealth direct to the grandchildren without having perhaps that ex-daughter-in-law having 50% of the asset, this is a great way to do it. So we forget that life insurance is really a very smooth way to transfer wealth. The other thing is private. It's very private, as opposed to when the estate process is a matter of public record. So we know that life insurance maintains privacy and things get transferred directly, and it's not part of probate. And then, of course, the fulfillment of wishes. So it's precise distribution of assets with flexibility and control. So the grandparent maintains that control of the asset prior to their death, or they can choose when to transfer it at their wish prior to their death or after their death, depending. So we'll go through some examples. What are some of the benefits for grandchildren? Of course, any grandchild is going to think any inheritance is a lovely benefit. But when we're talking about participating life insurance, the grandchild has that access to the cash surrender value to borrow off of or to leverage off of to start a business or start a home. We know that, housing is very, very expensive in Canada. So to get that head start on a down payment on a home by borrowing off the life insurance policy is an amazing, amazing opportunity. Also, funding retirement with the housing is so expensive. Many people don't have the financial means to also save for retirement, and pensions don't exist anymore. So, we all have to save for retirement. So this is a really great way for grandparents to pass wealth to their grandchildren's retirement. So really that long-term growth that you're seeing of that participating life insurance and the cash surrender value. We also reduce potential tax burdens. So remember that the accumulation fund values can grow inside the exempt life insurance policy on a tax deferred basis. Now, remember, insurance companies do make sure that the policy stays in exempt status, so tax exempt, which is great. And then insurance for life. So we know that as we get older, unfortunately, we become less insurable. We experience ratings, exclusions, or not in complete decline, APSs, all of these things become far more difficult as we get older. So the idea for a grandchild or newborn baby to get insurance, I mean, perfect. It's a really great opportunity for them to have insurance for life. Just another plug here. We're actually the only insurance company that does term for kids. So that's a really great way to get that insurance and then do conversion after the fact. So getting term for kids is a really great opportunity. And we also have a great child CI as well, in case you're not aware. So, getting that lifelong coverage is amazing. Okay, so what are some strategies to transfer wealth? So some alternative strategies that you would use or your clients would use is, really traditional during lifetime, of course, the gift, as I mentioned, life insurance. Okay, we can do term or par, using an inter vivos trust or a beneficiary designation for a RIF, perhaps. Upon death, we can do things through a will. There's testamentary trusts. If there's no will, then it's intestate. We can use beneficiary designations. But keep in mind, for each strategy, we have to figure out the cost. So there are costs to create a trust, and then trusts, in case you're not aware, actually have to do an annual tax return. And trusts no longer have preferential tax treatment. They are taxed at the highest marginal tax rate. So it's unless it's a Henson trust, which is a disability trust, it is still they are all at the highest marginal tax rate. So it's not beneficial necessarily to use trusts as much as it used to be. Timing, a testamentary trust is at death, whereas sometimes you want to transfer wealth prior to that. We talked about gifts, and that could be control. Do you want to gift your children? Let's say you have 3 children, but multiple marriages or stepchildren. It can get quite complex deciding as to who should get what and having that control. Life insurance can really make it a way where far more equitable. So flexibility, we know, how flexible is it through beneficiary designation depends. Of course, you've got to change. That's fine. Gifts, well, once you've gifted the money to the child, it could be in trust, but then the child would have potential access to it at age 18. We don't necessarily want an 18-year-old to have full access to a bunch of money, right? It's what are they going to do with it? We don't know. It's, buy a fancy new car rather than use it for post-secondary education or a down payment on a home or condo, depending on where you live in Canada. And then what are some of the impact on benefits? So we spoke about if there's a disability trust, you're protected from any clawbacks from other benefits. That's a more specific situation, but other ways, impact on benefits, perhaps clawback for OAS and that eligibility for GIS, depending on the grandparents' financial situation as well. Okay, maybe this is a good time. Leah, do you want to let me know, are there any questions in the chat?
Hi, Petra. There are currently no questions.
Okay, perfect. Just wanted to confirm. Okay, so one of the things about if you were to provide a gift, or if the grandparent were to provide a gift to their adult child or to a grandchild, and they do a gift of security. So if there's a gift of security to a minor, it will result in attribution of income to the donor. So the attribution rules in Canada are that the income, the interest and the dividends get attributed back to the adult donor. So it's not necessarily worthwhile to gift minors money. So that's exactly what can happen. So this is essentially showing as to why participating life insurance is better. Capital gains and then are taxed in the hands of the minor child. So, do you really want the minor child to experience capital gains? And then attribution is not an issue if income is deferred until the minor is an adult. So if you have registered plans or look, ding, 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 exempt insurance policies, that's what we're really highlighting here. Okay, so what are some of the benefits of permanent life insurance? I mean, I'm speaking to advisors across Canada, so the majority of you will know this, but of course we have those cash values. We have it accessible for various needs, so it's not something that when you purchase the policy, you have to decide, okay, this is going to be used for a down payment on the home. It's very flexible, and you can leverage and borrow some, and then that can be paid back and then borrow additional, or it can be paid back upon death. So different scenarios and strategies that we know that we can use with cash surrender values, which makes it very, very worthwhile. There are tax advantages of participating life insurance with tax deferred growth. And then, of course, there's going to be a non-taxable death benefit. So the liquidity upon death, privacy, direct to beneficiary, and then also enhances the estate value. So we know that the estate is going to grow based on the growth of the policy. Okay, so a little bit about our participating life insurance. So for those of you that aren't aware, we are the largest credit union in Canada. So what does it mean to be a credit union? So it means that we're not a publicly traded company. We're not responding to shareholders or the board. That is really, really good news. It means we're not changing our strategy or our people based on market. So it means we are the strong, stable, long-term. Our par account is 2 billion in size, not the largest, but definitely not the smallest. So 2 billion in size, operated by DGAM. It is currently at 6.3. It's going to be the dividend rate is currently at 6.3. It's going to be increasing in July, but the par account is actually performing over 8%. Our par investment strategy is nearly 50% non-fixed income. So very, very aggressive investment strategy. As you know, the equities market has been performing very, very well last year. So we've been performing very well. We have, we see it as being that strong, stable, long-term par account. And it's definitely been growing. We've been growing very, very strongly, as you know. And we're the first 5-pay in Canada. We have a 5-pay par product, uses enhanced insurance as the dividend option. And it's a 5-pay in the sense of it's a true 5-pay with guaranteed premiums over 5 years. It's not using an additional deposit option, which creates an early offset. It's a true 5-pay. Because as you know, when you do additional deposit option and have early offset, that cannot necessarily be guaranteed. And you may have to go back to your client to let them know that you have to, put more money into the policy. So we know that we're the very first 5-pay in the market. Okay, these are quotes from the Income Tax Act. So for those of you that love the Income Tax Act, here are some direct quotes from subsections. So some of the tax benefits of life insurance, and I will share this presentation so you can share these with your clients and accountants, but we have deemed disposition of contract on life of child can be avoided by transfer to a current spouse or common law partner or former spouse or common law partner as per separation agreement. And then deemed disposition of contract on life of child can be avoided on death of a policy owner by designation of spouse or common law partner as contingent owner. So we're going to chat about how to use contingent owners also in this, in the examples. A policy owner can transfer their interest in a life insurance policy where the child or grandchild is life insured to their child or grandchild at ACB, either during their lifetime or as contingent owner upon their death. So of course, when you transfer a policy, it's CSV minus the ACB. You can transfer it at the ACB. So that's great news. Was there a question in the chat, Leah?
No, there's no current question, just some excitement about receiving the copy of the presentation.
Okay, perfect. Yeah. As you know, accountants, some clients and accountants want to see this in the Income Tax Act. They want to prove they think insurance companies are all wrong. Well, we're not. Okay, so what is the generational legacy concept? So this is essentially where we're explaining exactly how this works in a picture and with very straightforward words. So then your clients can understand exactly how to transfer wealth using participating life insurance policy. We have 3 possible scenarios. The first, which is one that we just kind of went through as far as when we went back, but the grandparent to grandchild. So the grandparent would purchase the policy and the grandchild is the insured. During the grandparent's lifetime or upon death, the grandparent transfers ownership to the grandchild, either at age of majority, which of course is 18. Some provinces in Quebec, it might be, I'm not sure, but is 18. And it could be, pros or cons. I have an advisor I actually met with the other day, also with IDC. She loves to use the PAR policy as a wedding gift. I thought, oh, that's great, actually, because you know that if someone's getting married, hopefully they're at a mature age, and that's a perfect wedding gift because they have those cash surrender values either to pay off the loan or put a down payment on their first home or condo. And then the third step, of course, the grandchild becomes the owner of the policy, and then the grandchild has access to cash values. So each of these scenarios you can run differently in the generational legacy plan sales concept so you can and each concept is customized to your client. Don't forget that. So parent to child. So many advisors, of course, that we work with, especially, we have, Child CI is definitely one of our amazing products that beats out all competitors. So a lot of parents, of course, are purchasing the Child CI, and then at the same time, purchasing participating life insurance to get their child that head start for insurance. As I mentioned, you can also do term for kids with us and then convert it to PAR later, which is a huge benefit because, many times clients have babies and it's very, very expensive. You're not sure how much to purchase for PAR. So that's a really great opportunity where they can buy term and then convert it. So here is where a parent would purchase participating life insurance for the child. The child is the insured. And then during the parent's lifetime or upon death, the parent would transfer ownership to the child, either at age of majority or a later date. I always encourage a later date, just because at 18, they might just surrender the policy and get the cash values back at that time, which obviously isn't the best thing when we want the policy to grow and continue to grow over the life of the policy. And then step 3, of course, the child becomes the owner of the policy, has access to the cash surrender values. And if they're entrepreneurial like Jim Pattison or Walt Disney, there you go. They can start a billion-dollar business.
Petra, we have a question.
Yep.
How long from policy settlement can a policy loan be made?
Okay, so it's immediately. For us, it's immediately dependent. I had that question before, so we're pretty much right away. But it depends on the cash values available, of course.
Thank you.
Okay, so the third possible scenario that you can also run in the generational legacy plan is grandparent to adult, child to grandchild. So this is a really great scenario because if the grandparent, I always say, is much older, so they're, let's say, 80, and so they're buying a 5-pay, for example, and they're only going to pay for 5 years, but they don't necessarily want to transfer it to the grandchild just yet because perhaps the grandchild is still young and the parent, so it's ideal to have the parent as the contingent owner, and then the contingent owner would transfer it later to the grandchild. So you can essentially have ownership change, you can have beneficiary change. Just keep in mind here, though, that when you have the grandparent transfer it to the adult child, of course, does have the discretion and has the cash value available, and they have the discretion to transfer ownership to the grandchild. So whether or not they do that, the grandparent can put it in their will, and the executor has to ensure that will is, followed through. So. And then ideally, of course, the grandchild has the cash value available, but perhaps the adult child, it would make sense for them to keep it. And, the other scenario is that it could just be for grandparent to adult child and not include the grandchild ever. But again, that could be this going back to parent to child. When I use this example here from parent to child, I speak about a newborn child. But of course, it could be an adult child. If you have 80-year-old grandparent, they want to pay for 5 years, they have, too much money, and they want to insure their, 50-year-old child, of course, that's fine. So that would work with this scenario as well. So don't forget about that. We do very, very well when it comes to joint last to die, and the age, and essentially the joint age is very, very competitive. So if you're looking to do that, then it's really great for grandparents to transfer wealth when they're insuring themselves and for the joint age. Okay, so this is when you have, again, like I said, the grandparent to adult, child to grandchild. You don't have to do it this way, but this is our third strategy that you can run. Okay, now we'll do a couple of case studies, see how we're doing on time. We're pretty good on time. So, I see, is there a question?
We do have a question. If divorce happens, does the insurance become part of a spousal equalization?
So the answer to that's a great question, actually. I don't think so, because it depends on who the insured is. If we're having as the insured as the grandchild, then the divorce wouldn't necessarily impact it. But of course, participating life insurance is considered an asset. So if here, let's say you have parent to child. So I use the example 80-year-old does a 5-pay, and then the child is 50, and then that's an asset. So then if there is divorce, yes, that is considered part of the assets. So I can check with our legal and tax advisors as to how that gets handled.
Great,
And
thank you.
how
I
it
will let you
gets
know.
handled in divorce. I'm not familiar with that. Yeah, I
Thank you.
don't know.
Yeah, and
That's a great question.
I'll let you know if there's a follow-up to what you just said.
Okay, thank you. Yeah, because it is definitely considered an asset. same as investments would be. So it's really just about how that gets handled. Okay, so let's go through a couple of case studies. So the first one is this is pretty straightforward. We have John wants to help his granddaughter, Tanya. You see that it's grandfather, John, is 60, and then daughter, Amelia, is 35. Amelia has just had a baby, Tanya. And then John would like to set aside $20,000 over 5 years to invest towards Tanya's future. So one of the things that we do very well at Desjardins is all of our sales concepts are going to compare to a traditional investment. So we take participating life insurance and we compare it to a traditional investment, and even that, investor profile type. So we'll get into that in a moment. But we have Amelia has enough funds to maximize our ESP account for Tanya. She has sufficient life insurance to also provide for Tanya in the event of her death. And Tanya, newborn baby, good health, and insurable. So essentially, John has decided, okay, so he's asked his advisor, well, I have $20,000 I want to give to Tanya. What should I do? So he's questioning, okay, do I just put this into an investment account for Tanya, gift it to my daughter? What do you think? So the advisor is going to show two options. The first option is the traditional approach. The traditional approach is that John is just going to invest that $20,000 on an annual basis with his advisor into traditional taxable investments. And his investor profile is balanced. So we've chosen balanced investment. And then there's going to be a taxable transfer to the adult child, Amelia. And again, another taxable transfer to the grandchild, Tanya. But we're also going to compare if John should purchase participating life insurance for the baby, Tanya, and spend $20,000 over the next 5 years and purchase life insurance for Tanya. So we have that's the generational legacy plan approach on the bottom. We see it's tax deferred rollover to the child and then tax deferred rollover to the grandchild. So some of the assumptions that we've used for John's gift to Tanya, and this is information that we input into the spreadsheet in the sales concept. So on the left, you see the traditional approach. So the traditional approach, remember, that's depositing $20,000 to a taxable account for 5 years. So he's asked his advisor, well, what do you think? What should I do? Here's my money. And his investor profile is balanced. So we have the breakdown of assets, what the asset allocation is, and the rate of return. You have the ability to choose the investor profile and have it where you choose if they're conservative, balanced, growth investor, or even custom. So if you have essentially their investor profile, you can enter custom, you have their rate of return allocation, you can enter all of that, and we will create the report, or Desjardins Sales Concept will create the report based on a comparison using participating life insurance to their current portfolio, or the portfolio that they would choose for Tanya. Okay, so then on the right-hand side of the screen, we show the generational legacy plan approach, which is essentially using participating life insurance. So depositing $20,000 a year to a whole life 5 pay. Policy owner's John, so that's the grandparent. The contingent policy owner is Amelia, that's the adult child. The life insured is Tanya, newborn baby. The beneficiary is Amelia. So because you can't have a beneficiary of someone who's underage unless it's in trust. So it makes most sense for beneficiary to be Amelia. So were there a couple of questions, Leah, or?
Yes, thank you. We have a question here regarding payments if the life insured or owner changes residence. So the question is, what if they move to Ukraine with war talks? Would the death benefit still be paid if there was a death? What happens if they change residence with that payout?
Yeah, once a policy is in force, then policies can't be changed as far as death benefit. So if they move, and even for payments. So as long as the premium is being paid, we're actually the only company that accepts annual credit card, including international credit card, MasterCard and Visa. So if that client buys a 5-pay, moves to Ukraine, they've purchased the policy, and they've disclosed, if they knew at the time of purchasing the policy that they were going to move, and the policy was approved, they could move to Ukraine, use their Ukraine credit card, MasterCard or Visa, and pay the annual premium still.
Fantastic. That was one of the questions we had. And then we did have one other question. Could you put the funds into a term certain annuity with Desjardins and have the annuity pay the premium? In other words, can you have both the annuity and insurance with Desjardins?
Yep. One of our other sales concepts is insured annuity for exactly that. So, of course, used to be referred to as back to back. Maybe it still is. We will, as long as the minimum annual premium is $25,000 per year, we will pay the premium. The annuity will pay directly to the premium. So the client still has to pay the first year, and then it's the remainder of the 4 years if it's a 5-pay, or 19 if it's 20-pay, 9 for 10. And then the annuity, but again, the annual premium has to be a minimum of 25,000 for us to have the annuity pay directly. We do have a premium deposit account. So if the client would like to pay a 5-year all in one go, they can do that. They just have to pay the first premium, because of course that's part of entering into a contract, is paying premium first year. The remaining 4 years can be put into the premium deposit account, but it is a taxable account earning interest.
Great.
Similar to GIC, yeah.
Thank you. Those were the questions so far.
Yeah, and then just to clarify, if the premium is put into a premium deposit account, we just draw from that account. So the person no longer has to maintain any or has to make any payments. But again, it's a taxable investment account. Okay, so moving forward, so what are some of the options for Tanya's future? And again, here's where we're going to compare the traditional taxable investments. So John's first option of just, putting $20,000 into a taxable account for $20,000, or of course the generational legacy plan approach, which is participating life insurance and doing that for 5 years. So take a look at when Tanya is age 35, she could purchase home rental property. The account value of the traditional approach is only $290,000. If she uses the generational legacy plan approach or participating life insurance, then the total cash value is now $391,455. So that's essentially how the cash surrender value in the policy has grown with that 5-year par product. The total death benefit is nearly $1.9 million. To start a business, Tanya is entrepreneurial. She wants to start a business at age 45, and going to have only $401,000 if we had the traditional approach, versus the cash value available with par account is $730,000. And then that death benefit we see continue to grow. Now, let's say Tanya is not very entrepreneurial. She has became RCMP, for example, or maybe I shouldn't use RCMP because the retirement, but let's say she had a job and wasn't able to save anything for retirement because she knew that she had this participating life insurance policy, and then could use this to leverage off for retirement income, because the cash value available at retirement for Tanya at age 65 is over 2.3 million. Whereas the traditional approach, taxable investment account, is only 770,000. So when you look at these numbers, this is really where we're showing how participating life insurance just shines over the long term.
Petra, we have another question.
Go ahead.
Either now or once you finish up this slide, could you please mention a few important points to include in a reason why letter for the generational legacy plan?
Okay, great question. So what's the reason why letter, or what to include in the reason why letter for the GLP. So what you would include, essentially, obviously you have to do the financial needs analysis. The reason why is essentially for insurability for the child. So of course, protecting insurability for the child, like we mentioned, and then also for long-term, essentially long-term growth and access to, and also insurance protection for the mother, so that the mother has the death benefit access. So in the event the child passes away, there's that death benefit, of course, and then long-term access to cash values.
Thank you.
Okay, so using the 5-pay, I think we spoke to this mostly. So we see cash values starting in year 1, but we have guaranteed cash values as a policy year 3. I really see the 5-pay long-term performs very, very well. So at age 65, when we see for Tanya with how much cash surrender value it was, or even after the 25 years, it's going to be incredible. Also, that death benefit over the long term. So for estate planning, the 5-pay does very, very well. So it uses the dividend option of enhanced insurance. At year 10, it can be changed to paid up additions. And then it's very easy, simple to understand as well. It's not using additional deposit option that creates an offset, which may or may not have early offset, because sometimes policies don't perform as expected and you have to go back to your client and have them add more money. Okay, so again, something else, when I mentioned earlier about how we explain things very well in a picture, here we are in the report. This is going to compare the traditional taxable investment to the generational legacy plan, of course, purchasing participating life insurance. So we have the taxable investment owners, the grandparent's going to purchase taxable investment. Take a look at that cumulative tax paid. Nearly $84,000 or $83,000, and the grandchild only has access to the account value of $246,000. Whereas when we're using participating life insurance, look at the cumulative tax paid, 0. We have a tax deferred rollover with a cash value available at $282,000, and Tanya is 30 years old at this. So we've gone for John to essentially transferred from grandparent to grandchild, but it's we see it's gone from policy owner there. That's just an example. Okay, so what are John's estate planning priorities? Of course, provide Tanya with life insurance that will last her lifetime, protect insurability now and in the future. Of course, stability, provide a tax efficient gift to the grandchild, and then allow Tanya to access the funds at a later date when she is financially mature. So I always caution advisors to have money passed to 18-year-old. I know my oldest just turned 18, and yeah, she would use it to buy fake ID, but okay. Wealth transfer, structure a plan that will protect John's gift of lifelong insurance coverage for Tanya. So really great way to just protect that insurability and then transfer wealth over the life. Okay, so what about planning for the intergenerational transfer? So this is where I say that use the contingent owner. So having contingent owner just makes sure that if something were to happen to John, that it is transferred to Amelia as the owner, and then it can be to Tanya, but again, we talk about the correct age to transfer policies to children. Okay, the next case study. Were there any questions in the chat about that case study, Leah?
There are currently no questions.
Okay, thank you. Okay, so here is a more parent to child example. So where you have, family market chatting to them about they have a newborn baby. They want to set up the child for the future. You could be chatting about child CI and PAR for the child. They're like, well, I don't know, why should I buy participating life insurance for a baby? These clients, this one is for $10,000 for 20 years. It could be 2,000 over 20 years. You could do this example. Again, you run these reports yourself and you customize it yourself. So it doesn't matter. You could do it for $1,000 annual premium. It's still going to be beneficial and you're still going to show the benefit of that long-term participating life insurance and that long-term investment with Desjardins. So, of course, the clients have enough funds to maximize their RESP accounts for Olivia. They also have sufficient life insurance through term in the event of death. They also have updated their will, have named Jamie, Samantha's sister, as the guardian of Olivia. So that's good to know because we think about, contingent owner, what's going to happen to this policy if, let's say, they were both to pass away, who's going to continue to pay the premiums. So again, we're going to compare it to a traditional investment. So the owner is the parent. They're going to deposit taxable investments. It's a taxable transfer to the child. Very, very straightforward and common. Versus doing generational legacy plan, purchasing participating life insurance. We see it's going to be a tax deferred rollover. The insured is the child and the owner are the parent, owner's parents. Assumptions. So again, we're able to choose exactly the investor profile type. So in this situation, we put balanced, but if we wanted to put growth, we could do that as well. We have their different the allocation as well as the rate of return that will show up in the spreadsheet as a default. You don't need to customize that if you choose balanced. Only if you choose custom do you need to change the asset allocation with the rate of return. Whereas the generational legacy plan approach, we've chosen a whole life 20 pay, estate enhancer. We also have the 20 pay accelerated growth product. And of course, that's earlier cash surrender value versus estate enhancer is longer term and growth to the death benefit. Policy owner is Samantha. The contingent policy owner we have as Olivia, and then life insured Olivia, and the beneficiary is Samantha. I think contingent policy owner, we could have Jamie here if you wanted, but it could be contingent policy owner is Olivia, but in trust for Jamie. And then in the will, it can state the date that you transfer. So just keep that in mind. Like right now, the way that it's set up with policy owner Samantha and contingent policy owner Olivia, goes automatically at age 18 or age of majority. So what are some of the benefit of different options for daughter Olivia? Again, this is just going to give a summary of the different amounts. So versus the traditional approach at different ages, we see the cash value at different ages. So even age 35, let's say she wanted to start a business. Now she has 590,000 versus if you had an account value, just a traditional taxable account, it's 462,000, or let's say to purchase a house. So whatever age you want to compare, you can essentially compare to with the report would show you that.
Petra, we do have a question.
Kate, go ahead.
Two actually. First one, not too sure if you're going to know the answer to this because we are in BC. Can you name a minor as a contingent policy owner in Quebec?
Oh, so I don't believe so. I think you can name a minor as a contingent policy owner, but then it's going to be in trust. Like you have to put who the trustee is, same as other provinces. So I don't think you can name, like you can never name a policy owner cannot be underage and a contingent policy owner cannot be under the age of majority in your province. And so therefore then you would enter who the trustee individual is.
Thank you. The second question, how does this differ from an IFA?
Oh, okay. So an IFA is immediate financial arrangement, essentially where you're purchasing a policy and then you're immediately leveraging off of it and borrowing to invest, and then that interest is tax deductible. So a little bit different. So I would say that the IFA is a bit of a different concept because it's far more for where you're leveraging immediately. Whereas this is more of a strategy that is transferring wealth over the long term. So this is more of a cascading wealth strategy.
Thank you.
Okay, so here at the top, again, we see what the taxes are paid, over 109,000, and the account value is only 393,000 versus when you use participating life insurance, you have zero cumulative tax paid, you have cash value available, 423,000, and then take a look at that death benefit. This is 30 years later. So 30 years in is the cash value available. Okay, so what are some of Ben and Samantha's estate planning priorities? I'll just go through this quickly because I do want to go through an example. Essentially, of course, protect life insurance, protect our insurability. We always talk about that we know individuals get less healthy as they get older, unfortunately. Not always, but stability, ensure that the premiums will be paid no matter what. So the way that the parents could do this is through a premium deposit account or an insured annuity back to back if there is a minimum 25,000 annual premium. And then wealth transfer, of course, it's tax efficient, and we see that it's actually performed far better than the cash surrender values have performed far better than the traditional taxable investment. Okay, so here's where we're planning for the intergenerational transfer. We're using a contingent owner. So we see how Olivia is the contingent owner. And then, but if Olivia is under the age of majority, we have Jamie is the guardian of the property. So that's where she's the trust or the trustee. And then if Olivia is above the age of majority, policy ownership is transferred to Olivia. But I would recommend they mention in the will at what age Jamie transfers the policy just to ensure it's used for the right reasons. Okay. Okay, so just in summary, what are we showing here? Guaranteed insurance for life. We're providing a living gift. So as an advisor, you're able to show a comparison of traditional taxable investment to using participating life insurance, and it offers the gifter control of the policy. It simplifies the intergenerational wealth planning, and it reduces the income tax burden. So that completes the presentation. So that's for the CE credits. But what I want to do quickly for those of you that are able to stay on, I understand if you have to hop off. But I thought it would be a good opportunity to also show you quickly. This actually just takes a few minutes, so we should be fine. To show you exactly where you access the sales concepts within Webby. So here I am.
Quick question before we jump into that.
Okay, go ahead.
Do you recommend adding a term to par 5 for conversion at a later date?
So with the par 5, you don't have the option to add a term rider. You can do a separate term policy as well for conversion. So you're just mentioning about doing both, like do a par and term. Yeah, I mean, for sure. You can do that. There's no option to add a rider of term on our par.
Thank you.
Okay. Okay, so here I am on the home page of Webby, just to show you where we house all of our sales concepts. We're under insurance and then marketing sales concepts. You see that I'm logged in, but you actually don't need to be logged in to have this. If you don't have a login with us, we're actually the only insurance carrier that gives you a login prior to a new piece of business. You just have to request IDC to get a temporary code for you, and you can actually get set up right away. But again, you don't need to be logged in to access our sales concepts. I have the ability to add it to my quick links because I am logged in. So these are the different sales concepts. I had mentioned our estate needs calculator at the beginning, where the estate erosion, and that shows the clients that. So for the sales concepts, it's separated into affluent or business owners. And I'll go through its generational legacy plan is the one we just went through. They're all going to have the same look and feel where you have that little green drop down, click learn more. Each one is going to have 4 tabs or 5 tabs across, and it'll give you the how it works, who's the target clientele, illustrate how to create the illustration even, and then also some of the sales material. We will email these to you, don't worry. And then even examples of concept reports, but this will even give you how to create the illustration. Now, we go to the insurance illustration. We can send you the insurance illustration link. Again, you don't need to be logged in to access our insurance illustration system. It's all web-based. I'm going to go to PAR. I'm actually going to just go to the one from the other day, if my window could move. There. Okay, I'm going to do this one quickly. But here I have the illustration system. You see, I've added a grandparent and a newborn baby. So we have the policy owner is the grandparent. We're not able to add a child as a policy owner. And I go to the strategies tab. Sorry, I'll just show the product that I chose is a 5-pay PAR annual premium of $20,000 per year. So he's 60, he wants to pay for the next 5 years. It's got my issue date as yesterday. That's okay. You can backdate up to 6 months within our illustration system. Very useful. Then I would go to the strategies tab. I choose drop down, generational legacy plan, wherever it is. I export the spreadsheet. So you need to be able to export and allow macros, and the browser needs to allow that. We can help you with that, as can our IT department. So don't worry about that. I'm just going to quickly download the spreadsheet. This is where you input the information as far as what investor profile you have. And we quickly choose the scenario. I'm going to enable content. I can choose the investor profile here, conservative, balanced, growth, or custom. And I'll leave it at balanced. I choose the strategy. It's grandparent to grandchild. I go ahead and I choose the age of transfer. This is just, of course, for example, I'll say it's after the child's still quite young, so 20 years or even 25 years. And then that's all I need to do. I can quickly run the PDF. It's going to give me a lovely report, which I will email following this presentation, so you can do a deeper dive. And of course, we look forward to connecting with you on a one-on-one basis to go through this with your wholesaler in your region. Thanks, Zach. I think I'm like
Awesome.
right at 11. Yeah, sorry.
Yeah, no, that's perfect timing. Thank you so much. A lot of good information in there. Again, some things that stuck out to me, a lot of the sales concepts, a lot of powerful images. I think images really resonate with clients. I think avoiding probate, a lot of the people, or a lot of the aspect that not everyone talks about is the privacy of life insurance, to avoid that, right?
Yes, privacy gets forgotten at how valuable that is.
Exactly. And then a lot of the options you guys have for children's CI and term for kids, I think that's important too. More affordable concept with insuring children for that legacy planning. And then, of course, that 5-pay PAR. I know I'm hearing a lot more in Ontario interest on that. Clients are more, guarantees are more important to clients these days, it seems to be. So the more guarantees, the better. So yeah, that's awesome. Thanks so much to Petra and Leah for joining us today. And we look forward to seeing everyone again soon. Okay,
thank you. I think there might have been a couple of other questions. I can stay on. Leah, were there other questions or no?
No.
Okay, I just want to make sure.
I think we got them all.
Okay, perfect. Oh, good and great. You've shared the advisor page, the illustration. Excellent. Okay, just wanted to make sure that I covered everything and I had. Okay.
Awesome.
Excellent.
All right. Take care, guys.
Okay. Thank you.